Good afternoon, everybody. Welcome to the Trader Merlin Show. It is your Wednesday edition. Of course, it's a very special Wednesday. Multiple reasons it's special today. Of course, we had Chairman Powell and the Federal Reserve making their statement, which will spend the first portion of today's show talking about the FOMC statement, maybe anything that might be new there, or as Yahoo, I think it was Yahoo News today, said, utter defiance from Jerome Powell against President Trump. Like, really? Utter defiance? I think this is just called common sense, but, you know, it's okay. We'll let the media hype things the way they want it to be. The second great reason for today's Wednesday is I am joined with none other than Mr. Bill Addiss for a 2026 market outlook. Of course, we'll talk all things Fed and interest rate related. So, Mr. Bill Addiss, how you doing today, my friend?
I am wonderful, Merlin. How you holding up?
I'm good. My throat's still raspy, so I'm going to try to mute my microphone when I cough so it doesn't blow your eardrums or the audience's eardrums. But yeah, we're getting better. Slow men for this cough. Everything else, I feel absolutely fantastic.
Get healthy. Get healthy.
And I'm feeling much better now that Tesla, I had a position on Tesla that the audience knows about, and I was very close to covering it today because I don't like holding things through earnings. And it's kind of right at my strike price, but I held it, and we'll see. It's performing nicely in the after-hour session, so feeling pretty good about today. Other than that, I'm great.
Wonderful.
Yeah,
good,
absolutely.
Good. Happy Wednesday.
Happy Wednesday. So Jerome Powell, Federal Reserve, utter defiance is what I read from one media outlet today of President Trump. Keeping rates the same, that was pretty much a foregone conclusion. I think as of yesterday, there was like a 97% chance of that happening. Is this a surprise to you, or is there anything said today at the press conference that shocked or was out of the ordinary to you?
Nothing other than that Jerome obviously wanted to stay very much on script. You know, there was a lot of things he didn't want to talk about that he has talked about in the past, you know, the strength and direction of the dollar. You know, he obviously doesn't want to get into who's going to be replacing him or anything, but to not want even gold, to be talking about the value of gold. I mean, these are topics that he has ventured into in the past that he obviously was very intent on just staying on script. He's got 2 more meetings left. I think he's looking at the end zone.
Yeah, and you're right. I just brought up the chart of gold here real quick just because some of the stuff was wild today. And I did a show on, today's Wednesday. I did a show on Monday. We had this shooting star on silver and other metals, and I actually bought some puts on silver on Tuesday, and when it came through, entered my entry price, and skyrocketing yet again. I mean, this thing is just unbelievable. At one point, I will be right on my shorts here. Luckily, they don't have large positions, so it's not costing me a lot. But, you know, gold up another 6% today. Fortunately, we did have that dollar bounce. And I don't know if you saw President Trump speak on this one. It was kind of funny. They asked him about the dollar, and he's like, no, the dollar looks great. I really like the dollar. The dollar looks fantastic. It's like, it's tanking, dude. It's literally falling off a cliff.
He even acknowledged he was tanking and said he didn't care.
Well,
he said even more.
He said early in his campaign that he wanted a weaker dollar. So did Scott Bessent. So this is, you know, kind of going in line with what he wants. He's got to be pretty happy with this.
The Sell America trade apparently is working for him.
Sell America trade. Hey, it's helping the equity indexes. We had the S&P again ripping to the upside. You had all-time highs put in yet again. Just kind of wild that this thing keeps rallying like this. Was there anything from a quantitative tightening or easing perspective with bond? Because I didn't get to see the statements or the press conference after. I was in meetings today. Was there any change there in the trajectory of what the Fed's doing with their portfolio?
Yeah, yes, and I wish I too was in an XLT class for much of the class, so I was with you guys, but I caught some highlights. He did talk about that the deterioration in the jobs market is improving.
Okay.
Which was about the only sign that he was giving one way or the other. You know, he talked about inflation. He was hit with, you know, the fact that even the Fed's looking for inflation at 3% next year. So, you know, the fact that we're still not hitting the targets there, the fact that the jobs might be improving, doesn't lend a lot of credence to another rate cut. You know, if you look at the futures markets, I think you saw that for between now and May, they're not looking for any futures markets isn't looking for any changes. But once we get a new FOMC chairman in there, we can pretty well expect some rate cuts. I mean, whoever gets the job is going to want to thank their boss.
True. Right now, as we go for March, there's an 86% chance we keep rates right where they are at and stay the same. You go to April, which is the last meeting for Jerome Powell, that's still a 74% chance that rates stay the same. And as you pointed out, once you get into July and we have a new Fed president, there's a 47% chance of a 25 basis point cut. But, you know, who knows what on earth is going to happen between now and then. It's not just you appoint a new Fed chairman and all of a sudden rates are guaranteed to get cut. We have a lot of economic data and market turmoil or euphoria, which could persist between now and then, which could certainly influence the decision. For those who are wondering,
and the Fed chairman is only one vote. Just because we have a new chairman, that's only still one vote.
Correct.
So, sorry, go ahead.
Yeah, no, you're right. And I want to say, for those who are curious of what the forecast is for the end of the year, I didn't catch the dot plot today, but the traders who are trading Fed funds futures are pricing in 2 more rate cuts, 33% chance of that by the end of the year. So we've got 2, 4, 6, 7 meetings between now and then, and only 2 rate cuts. So don't expect a lot of chopping going on between now and the end of the year.
What I didn't hear about, which I was hoping to, quite frankly, is the whole tapering discussion. The Fed's due to stop their tapering in February.
Right.
And I was at least hoping the topic would come up, and it wasn't even mentioned.
Does that concern you, that there was a lack of transparency? Isn't the right word, because you've emphasized this in the past, that the past few chairmen with Bernanke and Yellen and now Powell have been very transparent about policy. For him to not talk about specific things like gold and some other key points, does that concern you, or is that just kind of him? You think he's just going to, I just want to deal with this right now?
I think it's just less aggravating, to be very honest with you. I mean, I really do. I mean, as he said, the Fed has no policy statements on the dollar. The Fed has no policy statements on gold. So for him to be accused of going outside of his bailiwick, why open himself up to that pressure? So the Treasury wants to discuss the dollar. They are free to do it. But let's admit it. That is a little bit, playing Pontius Pilate and washing your hands of it.
Sure.
When interest rate policy affects the value of the currency, and when we have rates going up and the dollar weakening at the same time, that's a bit unusual. It should warrant some attention. That's in an exaggerated sense. That's exactly what's going on in Japan right now, right? Mm-hmm. You got a whole repricing of the Japanese market. Well, that does affect policy decisions.
Sure. Big M says, but doesn't the chair have some sway over the other members to some degree?
Not really. Moral suasion is what they like to say.
Right.
I mean, the chairman of the Fed really has some sway, but really only in terms of the structure of the meeting itself, not the voting policies. Just, and we're not making it too much of a history lesson, but, back in the days of Volcker, he didn't believe in the public announcements, in the public disclosure. So Volcker, as the chairman, set a policy of, we're not going to tell them what we're doing. Along comes what was his name? Greenspan.
Greenspan, yeah.
And his policy was to open that door a little bit, and Bernanke even more. So the chairman set policy like that. The public relations aspect, the press conferences, whether they want to do press statements, those policies the chairman directs. But in terms of actual monetary policy, he's just one vote.
Yeah. Well, I don't know. I think that there's got to be some kind of sway at that meeting. Like, okay, well, when you're with a group of friends and you're all talking about a specific topic, there's always that one character who will, convince and persuade everyone to kind of go in a certain direction. And
right.
Not everybody does, right? But depending on the arguments that are cast. And I'm curious to see what he would be like behind closed doors.
Oh, God, yes.
Because publicly, he has this very neutral stance. I'm data dependent. Doesn't feel like he wants to sway anybody. But I wonder if behind closed doors, he's like, no, you guys better talk about that. Just pointing the finger and yelling.
Well, adding to that comment, I think he kind of waved a little bit of a political flag last week when he went to the Supreme Court. We're referring to Powell here. When he went to the Supreme Court about the hearing for the Fed governor with the mortgage fraud.
Yeah.
That was a bit of a public statement, a political statement for him to go to the Supreme Court, and Bernanke was with him. For the two of them to attend those judicial hearings, that also is kind of outside their province, if you will.
Right, but you're also standing up for one of your own, right?
Oh yeah, absolutely, and I give him credit for that. Yeah. Absolutely.
Yeah, standing up for his posse. A lot of weird things happen. One thing that maybe you could shed some light onto is what happened over with Japan's bond yields. Watching those yields surge like that, you had a lot of people really freaking out. From the general discourse that I was hearing, a lot of it had to do with a lack of confidence in Japan and their ability to pay back their debts. What do you think was the cause of that? Do you think there's going to be more escalation of those yields?
Yeah, no, this was a whole repricing of the market. And this shows you that any economy, how quickly things can turn around. So what happened in a nutshell for any of the audience that missed it is in the yield market in Japan, we had a major repricing. I mean, long-term yields, 10 years and beyond in Japan over the last 2 weeks are up by 100 basis points, 1%. We
Wow.
had one day last week alone, in one day, that the 10-year went up by 31 basis points in one day. So the yield curve is just steepening dramatically in the long end. But I do want to point out, and by the way, the other thing that's really not in sync with that is normally when you see rates rising like that, it strengthens your currency,
Right.
right? It makes your currency more attractive. Speculators are going to come in. Well, this has been so dramatic, it has scared the currency market, and the yen is substantially lower. So, you get the worst of both worlds. So you've got the currency being hit hard, and you've got interest rates being reappraised. But what I need to remind everyone, and we talked about this a lot during the pandemic, the Bank of Japan was very aggressive during the pandemic in their quantitative easing. They did even more QE than the US did. And what they did, which was very different than almost any other government in the world, central bank in the world, is they actually targeted long-term yields, like the 10-year and the 30-year, and said, this is where we want those yields to be. And to do that, they had to distort the market by buying most of the 10-year treasuries in the
Right.
Japanese market. They literally had to come in and just soak up all the demand, much like the US did during the pandemic when they dropped long-term yields down to 2%. Only Japan kept this going for 3 years. For 3 years, they artificially kept their long-term yields at these depressed levels for their QE initiatives.
Right.
So this is like all that pent up, it hasn't been able to move for literally the last now 5 years, including the pandemic time. So once they took those barriers off, which did happen last year, it wasn't just recently, but now that the market is free to move, it's kind of, if you will, making up for lost time,
Mm-hmm.
because our rates have gone up over the last 4 years and Japan was artificially holding theirs down. Once that lid has been removed, now we see where the market really goes. So with a little bit of historical context, this yield change makes sense.
We look at the surge that happened in the yield there, and I've got the Japanese yen futures, and over the past few days, there's been a pretty significant jump. The past 4 days in the Japanese yen, and going back to those normal correlations, when you have
Right.
the yields jumping like this, that means you're going to have more people trying to buy Japanese bonds, therefore they have to buy Japanese yen to buy those bonds, and it would lead me to believe that this might be a reversal time for the Japanese yen and starting to see some more strength build in it, if in fact we do see yields continue to rally.
Yeah, no, that would be the normal relationship, and I would expect at some point we should go back to that. I would agree with you. This is just, this type of disruption is not usually long-lived. It's much like what we saw in the U.S. Remember last April when
Yeah.
we had that week when interest rates here in the U.S. rose so dramatically?
Mm,
We were kind of repricing in, forgive me to say it, the President Trump risk, if you will.
right.
And, the dollar took a dive, yields went up. We experienced in a smaller degree much the same thing back in April.
Yeah.
And it only lasted about a week for us.
I'll take a week. Week's fine.
Yeah, right. Exactly.
Better a week than 3 or 4 years.
Yeah, well, that's it. I mean, Japan was so aggressive in their quantitative easing. They were literally printing money for 5 years in their effort to keep long-term yields artificially low.
Our yields. So I've got
Yeah,
the 10-year bond up here, which to me is, I guess they're all important. Obviously, the short, intermediate, and long term. But for me, I put more emphasis on this 10-year bond because how it ties to so many
sure.
different markets.
Yep.
We had a pretty significant sell-off in it from May through November, and now all of a sudden feels like it's found a footing. And you've been saying that you feel that this yield is going to increase. It's going to have a steepening trade here as more people or as the government struggles maybe and offers more yield. Demand for the 10-year drops. We've got a nice little uptrend here. Are you still in that bullish mindset for that 10-year?
I still am. Yes, I'm still an advocate of the steepening trade. If you look at the yield curve, I think it's a pretty foregone conclusion that we're going to see a steeper curve over the year. Even if the Fed doesn't cut short rates, but I think they will. But even if they don't, I think long rates are going higher. I think by the end of the year, the Fed will be cutting short rates, again, with the new Fed chairman and whatever. So yeah, I think the yield curve is going to get steeper. I think long-term rates are going to go up. And I'm more and more kind of depressing myself. I'm building up an argument that I'm not ready to present too much, but I talked about not so jokingly, the sell Japan trade,
Yeah.
just sell everything. I fear we're starting to see somewhat of that in the U.S. Treasury market, of a sell the market philosophy.
Okay.
Um, we've got a couple of things going on. You got a minute for this? Because this is kind of leading us into 2026 as well.
Let's do
But
it.
I do, okay, because I think we're building to potentially a supply demand problem, much like what we saw during the pandemic. So, as you know, the deficits aren't going down. The deficits are only increasing. Last year had our third largest deficit in history, and that was when the economy was doing well. So let's assume that deficits are going to continue to rise.
Okay.
Then the problem becomes, what is the demand for U.S. Treasuries going to be? Who's going to buy all these treasuries?
Now
Now,
you're feeding right into my love line
I
right
know
here.
I am, exactly. I'm going in, and there's pluses and minuses here, as you know.
Mm-hmm.
But let me throw the minuses out, but then we can finish with the pluses. How's that? We can
Sounds good.
finish on a strong note. Out of Davos has become a bit of a sell America philosophy. Sweden has announced the sovereign fund is selling their U.S. treasuries. Denmark is doing the same thing. There was even rattlings out of the European Central Bank about reducing U.S. holdings. So I'm worried about a politically motivated sell America trade here in
Yeah.
terms of U.S. treasuries. And I think we're already starting to see it, quite frankly. I also worry about the international finance scene that created all this demand for treasuries. So, and then I've said this before, and I'm sorry I get a little nerdy, but a lot of the buyers of U.S. treasuries are the OPEC nations.
Yep.
I spent a lot of time in Kuwait and Dubai because they were the number 3 and 4 buyers at one point. And all of the OPEC money goes into U.S. treasuries. Saudi is the number 3 buyer of treasuries, not because they like the dollar, not because they like President Trump, but because they have a lot of dollars from their oil sales. So they're just looking for a safe, liquid place for that. Well, starting in 2025, last year, OPEC is now doing trades in more than just US dollars.
Right. Which should be their
It used to
prerogative.
be, I don't disagree with that, but understand the way the system was set up, we had a captured audience. The
Yeah.
US, when OPEC was created, the US was the largest consumer of energy. Now we're a competitor of OPEC. So I understand that they need to go multi-currency. It shouldn't be a dollar-based system. But the net result of that is going to be less purchases of US treasuries.
Mm-hmm.
India is buying buying oil from OPEC now, and they're doing it in rupees.
Yeah.
And India is a huge economy for OPEC nations. So this is not only, this is not money that's now going to be used to buy treasuries.
Right.
Also, if you noticed, I'm sorry, go ahead.
I was going to say,
Go ahead, I'm
no,
sorry.
you're good. You're good. And I was going to say, it would make sense for anybody who's buying oil to go. Japan wants to buy from Saudi Arabia. It's like, okay, well, I'm going to buy it with my Japanese yen. And
Absolutely.
ultimately, I was talking about this with my class the other day. It feels like if I'm Saudi Arabia or a major oil exporter, I'm just setting up a currency exchange within my company so I can exchange that currency. I'll even make a little bit on the spread when I convert yen
Absolutely.
into whatever currency I want. There you go.
Absolutely. And you're also going to do the trade cheaper with Japan because you're not telling Japan they have to convert their yen to dollars.
Right.
They can just do it with the yen they've already got. No, it makes absolute sense for OPEC to do this, but that doesn't mean the result is good for us,
Right.
quite frankly. And there's also a huge reason why other countries should do it. And I don't know if you caught it. India's big on my mind these days, but the trade treaty that India just passed with the European Union
Yeah.
has been 20 years in the making. And they finally, because of political pressures that happened in Davos, got the deal done last week.
Yeah.
We're going to see huge trade going on between Europe and India. That is a hot, growing market. I mean, look at that economy with an 8% GDP rate. And we're missing that business. So I'm worried about a sell America trade relative to treasuries, relative to the dollar. And unfortunately, you couple that with Congress's overspending. I could see a problem here. Now, I'm not looking for the collapse of the U.S. economy. Don't get me wrong, but I am saying this is all arguments as to why we're going to see upward pressure to long-term interest rates.
Right.
I'm not calling for the collapse of the U.S. economy. Let's put this in perspective. But I'm going back to our conversation about why I think long-term rates are going to be going higher.
Well, and I think what you're calling for is identifying that actions have repercussions, and when you invade a country like Venezuela, and then you threaten to take over Greenland or Iceland, whichever it is on the day he can remember what it is, you ruffle feathers, whether it's the right decision or not. You're making some enemies out there, and right away when you saw the UK stand up to it, and it seems to me like that was almost a rallying point for the European community, and maybe that's what helped facilitate the India deal. And you're right. The concern is, at what point do we start to lose some of our alliances because of this? And if that happens, then you start to get, as you mentioned, less people buying government bonds, treasuries. Right now, our government has a funding issue, and not that I'm with you. I'm not saying the collapse of the American economy at all. We still will be one of the strongest in the world. But when you start to lose relationships with some very strong, powerful trade partners, that does have a longer term impact on the economy. And I don't know how that all shakes out, but the dominoes seem to be falling that way.
Yep. Yeah, and whereas I see buyers kind of sloughing off to the side, I don't see new buyers coming in, with the one exception that you like, is the stablecoin market. That is the glimmer of hope of increasing demand for treasuries.
Now with that, well, we can talk about stablecoins, and for those that would like more information on that, you feel free to type in a chat, but stablecoins are going to be a significant supporter of short-term treasuries and creating a buyer. And I've mentioned this before. I'm not a huge fan of our government, but the passing of the Genius Act might have been one of the smartest things they've done, because not only did they create a buyer for U.S. dollars. If you want to be an issuer of stablecoin, you have to back it with U.S. dollars. Done. You have to back it with short-term treasuries. Done. And you have to participate in the repo market, which adds more liquidity to our financial system. This is like a trifecta of victory that the politicians can parade around. But that only really is going to benefit that short end. I'll bring up the yield curve here.
Exactly.
You look at right now, you've got your 1 month is yielding 4.1%. Your 3 month is 3.979%. Those numbers will most likely start to drop, right? So Big Eb, one of my viewers here, in his little bond ladders he's doing, because he learned that from you, I think, his bond ladders are going to change significantly, because, now instead of getting 4.1, he might be getting 3.8 or 3.5 or 3%, because it's not just that you're going to get more buyers. You're going to get all American businesses or any business that issues a stablecoin will be required to buy short-term treasuries. And that could really have a profound effect. So yeah, that could bring the short end of the yield curve down, but that's not going to impact this long end at all. I guess the long end will go back to what it should represent, which is a reflection of confidence of the economy. And by its steepening, that's not a big vote of confidence.
And I continue to stress, again, I keep liking everything back to the steepening trade. But as you said, short-term rates coming down because of the strong demand from stablecoins, which we look to see, would also result in a steepening of the yield curve as well.
Right.
That's my real trade for 2026 is the steeper curve.
There's an interesting question from Marsha. She says, what about the safety of U.S. bonds as an incentive to hold them? There's always that comment that, well, short-term treasuries are the risk-free rate. It's risk-free. The government will never default. And while the government defaulting certainly is not a high probability, it's not off the spectrum of probability given the amount of debt that they have. So, what about the safety and security of short-term treasuries as an incentive?
Well, there's two issues there. One is the political machinations, right? I mean, we have the potential for a government shutdown this Friday. All because of, the circular firing squad that Congress creates for themselves in the budget passing process. Right. We have the money we need. We just need to authorize ourselves to pay it. I mean, how absurd is that? So you get these technical bureaucratic issues out of Washington that sometimes have created the government shutdowns, of which we've already had the longest one in history just last year. So there's that issue, but that's just really kind of technicalities and politics. The issue of demand, the issue of bankruptcy comes if we can't borrow the money we need to run our government. And as I say, we're a long ways away from that. But if I could personalize it for just a moment for investors to understand, you mentioned Ed has the 1 month T-bill roll he was talking about, or he keeps track of 1 month T-bill rates. So to give you an idea, next Tuesday, the U.S. government has about $56 billion of 1 month T-bills, including maybe some of Ed's, that are going to be maturing next week. So the government has to pay $56 billion on those government-backed treasuries, right? You buy them for the safety, government-backed. Well, guess what? The government doesn't have the money to back it. So when the $56 billion bill is presented to the Treasury next week, we don't have the money for it. So what is the Treasury going to do? They're going to issue $60 billion of new 1 month T-bills.
Right.
And the first 56 billion will be used to pay back Ed and everybody who bought the old ones. But that means a month from now, we have a 60 billion that we're going to have maturing.
Right.
I mean, understand the lunacy of this is the government never actually pays off its debts.
Right.
The only time I saw the government pay off its debts was 2 years during the Clinton administration when we actually had a surplus and the government paid off some government bonds early.
Mm-hmm.
But with that 2 year exception, we've never paid off our debt. We just continue to accrue it. I really believe this is becoming an issue that has to get more publicity.
Let me go back to that real quick.
What does a government guarantee mean, I guess, is the answer to my question.
Right. And let's just to kind of put the numbers into perspective. You mentioned $40 billion that they have to pay on this interest. So they'll issue $60 billion so they can pay that 40 plus get ready for the next tranche. As they issue more and more bonds, because the next time it comes due, they're going to issue 80, and then they're going to issue 100, they're going to issue 120.
Right.
What I want those that might not know bonds very well is the whole point here is the government have to borrow more and more money. The more they borrow, there's a lack of confidence that you're going to see that confidence continue to erode slightly. And the more bonds that they sell, if buyers stay the same and more bonds are issued, they're going to have to offer a higher yield, which means now the government's going to be paying back these bonds at a higher interest rate, which puts them even further in debt and will cause them to sell more bonds. So it's almost like this cascading effect. So until spending gets reined in, and this gets back to some semblance of normalcy with regards to spending, this is a runaway freight train.
Yes, I really do believe that. And again, as long as we continue to have buyers, we can breathe a sigh of relief. But that's no guarantee going into the future.
Well, especially as you mentioned, if we are, in fact, pissing off all of our allies by some hostile actions, they're going to flip the bird and be like, I don't want to do business with you guys. We're not buying your treasuries.
Absolutely.
I'll go buy some European bonds or some other bonds, but I don't need to buy yours.
Absolutely. And the more we alienate our neighbors, we're alienating our buyers.
Maybe as an alternative, let's think about it from a global perspective, because if governments like Saudi Arabia says we're not going to buy short-term treasuries, where would they go, right? Where would they go to park their cash? I mean, obviously, I wouldn't imagine they want to go be buying Turkish bonds or something like that, but do they go to the EU because of maybe they're the second stable?
You'd want to go to the deepest markets you could. That is also one of the beauties that the American market brings. At the $39 trillion mark, we're 40% of the entire world's bonds. So we are literally the deepest market. So if you want liquidity, you're going to be coming here. Next would be the European market, again, because of a size issue, EU. And as we know, there is some good correlations between EU and US dollars. So there's ways of hedging that.
Yeah.
But no, you'd have to look at the European market. And then, the other thing, and I'm depressing myself. It's time for Prozac, I guess. You look at what's happening with the BRICS in terms of going back to the oil and the cartels. And, the BRIC movement is a strong movement. That's not a dollar-based movement either.
Right. Just what do you think of the BRICS? I mean, come on. I have my strong opinions on this one, but I'm curious to get your take on the BRICS as a viable alternative.
The classroom are getting together. The nerds in the classroom and the underachievers in the classroom are all getting together to form their own club.
But in that analogy, though, the nerds and the underachievers, quite often, they don't like each other. And that's exactly the same thing with the BRICS. You can't tell me that India and Russia and China and South Africa are all like chummy buddies.
Can you tell me the G20 are all buddies?
Good point.
How'd that meeting go last week? Where was that? Davos? How's the unanimity amongst the G7 or G20?
Good point, but that's running a global currency. And here's my biggest problem with the BRICS: if they're going to be running a BRICS currency, right? If I'm I don't know, I'll just pick China, right? If I'm China and I'm having a major economic issue, I want to be able to manipulate my currency to benefit my country, a la what the United States does. And every other country that has a fiat currency. When you're BRICS and you're tied to another country, you can't do that, right? Because India might be like, well, no, we don't want to devalue the currency. We need it to stay strong for our economy. And Russia's like, well, keep it right where it's at. I mean, look at the European Union. This is when I was
just going to say, why is that any different than the EU?
And they have some cracks in the armor. I mean, I remember when I was brought over there, I was interviewed by a Spanish news station. They said, what do you think of the euro? They had just switched to the euro. And I'm like, from what perspective? I'm like, well, as a tourist, this is the greatest thing ever because I have an accordion wallet of all the different currencies. Now I just have one. Amazing. I go, as a citizen, though, I think this is a terrible idea because my government, if I'm German, my government can't do anything individually to manipulate the currency to benefit my country. It has to now, be thought about with Greece and Italy and France and all these different countries. That just makes it much more difficult. I don't see it working.
Oh, and understand, I think the euro is one of the most amazing financial engineering feats that was ever accomplished. I'm not sure it's going to be successful, but the fact that they got these countries to forego their sovereign currency
Yeah.
and their sovereign banking. I mean, could you imagine even trying to get North America, 3 countries or, whatever, in North America to do that, let alone all of Europe? It was the most daring experiment financially I think we've ever seen.
And to be fair, it hasn't failed.
Yeah, but I think it's still early, but yes, no, it hasn't failed.
Yeah.
But, it's a process. It's a growing process.
It's funny. I look a lot of times at the services and PMI and manufacturing numbers that come out for the different European countries, and you can see some that are just really dragging the whole thing down, and others are holding the whole thing up. It's like, oh,
Exactly.
yeah. I mean, could you imagine just the United States if we split it into 50 states and started, saying that one country would be the one that gets to make all the decisions? There's a lot of states that be impacted by that negatively and positively, just depending on which state they are. But yeah, I just don't see it working. I don't see it.
And that, as a reminder, that's actually what happened during the pandemic. Coming out of the pandemic, Germany was worried about inflation because Germany was starting to experience inflation at the manufacturing level. So Germany is there screaming, we got an inflation problem. Meanwhile, the EU is saying, no, we got Europe closed down. They're cutting while German inflation was rising. That's why Germany kept pulling back its representatives to the EU because they were just so frothy as to what the EU was doing was going to hurt Germany, and it was.
Yep, absolutely.
And the biggest economy, and they were willing to hurt it.
Let me answer this question.
Daring experiment.
Yeah, well, let me answer this question from Steve, and then I got another one for you. He says, are stablecoins seen as an investment or just a place to hold short-term money? I would argue it's a place to have digital dollars, right? So you're technically keeping that asset at $1 worth of value, but you're earning interest yield on it. And the point here is actually you won't be earning interest yield on it. The producer of that stable coin will be the one that gets to keep that interest. Right now in the Clarity Act, that's one of the areas of contention, is that they will not allow the stablecoin issuer to pay that interest out to the end user, which is why Coinbase is upset, because they want you to hold USDC, which they're a part of, and they'll pay you 3.5%. Under the new rules, that won't be allowed. Why? Because the banking system would get screwed in all this. If stable coins would automatically pay you 3.5%, Wells Fargo or Chase, who's paying you 0.01%, is going to have to fundamentally change the way that they do business, or they will lose customers. And if they jump from 0.01% to 3.5% for savings deposits, their bottom line is going to get impacted significantly. It's a small amount of interest, but you're talking on billions of dollars.
Yeah. Wait, is it fair to say, Merlin, in answer to his question also, that the use of stablecoin really is for payment services and liquidity?
Yeah.
It's fixed price. The goal is to be fixed price. It's really for ease of transactions is what it brings to the table.
Exactly. Ease of transactions and also record keeping, because it's a much clearer record of all the transactions that have gone on. And I mentioned that there's some definite clear winners, in my opinion, with the issuance of stablecoins. Any online retailer, I think, could do tremendous amount of volume in business, like an Amazon or Walmart. Even maybe something like a Home Depot could do really well by issuing their own stablecoin, but time will tell how that all pans out. Go ahead.
I'm going to be cynical, if I could, for just one moment before we move to your next question. Isn't that what we were promised with Bitcoin?
I don't know if we were promised. You have the orange pillars who were saying
expectation was that it would be a medium of exchange.
At which it is a medium of exchange. The problem is, for me to send you Bitcoin right now would take, depending on how congested the network is, it would take a minimum of 10 minutes, maybe up to an hour. It's not designed to be a peer-to-peer payment network like right. I'm buying an ice mocha frappuccino at the Starbucks, right? It's not built for that.
But and again, maybe this is a tangent we don't need to get into. But what you're saying is, in the existing process, you have to sell your Bitcoin to convert it to dollars to do the transaction you want.
For now, for example, for now.
For now,
and
that's what I'm saying. I think is the disappointment of Bitcoin.
Yeah,
it's not a coin. I can do that with anything. I can sell anything, convert it to dollars to buy something. What I'm hoping is that stablecoin will really become that medium of exchange that Bitcoin has not.
Yeah,
I think the product is still evolving, and I'm a huge proponent of the stablecoin market. But I got to tell you, I think the cryptocurrency market in general has been lackluster and hasn't come through with what it promised.
Yeah, I would agree. And I think the major component to that is adoption. When you have a business, so let's say I'm Amazon, and I'm afraid to take cryptocurrency as payments because there's two pieces of recourse to me. Number one, if I'm holding cryptocurrencies on my balance sheets, I have an undetermined amount of volatility and uncertainty with regards to my financials. Number two, if I do take a big hit because I hold Bitcoin on my balance sheet, the shareholders could technically come back and sue me for holding unregistered investments that threaten the profitability of the business. And that's why I think businesses are like, I'm not touching this because we don't have clarity. Now, if we fast forward a year and this Clarity Act is passed, then we'll have an understanding. Businesses will know, if I hold crypto, what's the risks to me from shareholder perspectives. Then what you're going to see is a rise of exchanges, which when you pay, let's say I go to Home Depot and I scan my Bitcoin to pay for $1,000 worth of lumber. Home Depot on that back end, on that app, will automatically convert that to dollars and remove that risk, right? So you're still saying the same thing, which is I just have to pay my Bitcoin and convert to dollars. But it's up to the consumer on what they want to receive. So if Home Depot in the United States accepts my Bitcoin and says, I want to collect that in Ethereum, that's their prerogative, and the new exchanges will facilitate that. So these are all, systemic upgrades.
Well, why would they do that versus stablecoin? Why Bitcoin versus stablecoin?
Because a lot of people have Bitcoin, right? So Bitcoin still remains this big medium of exchange. It holds its value. Well, not right now, but in theory, based off the principles of supply and demand, will continue to hold its value. And it's not meant to be, even though the white paper says it's a peer-to-peer payment network, it's really more of what gold is, right? Which is a store of value. Hold on to this thing for a long time, and if you need it, you spend it.
That's what I see it as. That's what I see it as. Exactly. Yeah. Okay.
Sorry,
tangent.
No, it's good. Question. Hey, these are discussions that are very valuable. One of the things that I think you realize, and many people are starting to realize, is that this entire system, how you used to sell and buy bonds, those systems are changing, right? The rails on which bonds are issued and distributed and paid out interest are moving on to digital rails like blockchain.
Absolutely.
So when we have tokenized treasuries and tokenized 10-year bonds, like, okay, how do these systems take this new technology and implement old school assets on top of it, right? How do we get the entire stock exchange on blockchain? And that's something that over the next few years we will have much deeper discussions on, because it's still to be determined exactly how those systems are set up.
And that's where I continue to see, though, huge growth and evolution in the financial services industry.
Yeah.
I mean, we love blockchain technology as an industry.
As you should.
We're using it as we should. Oh, yeah, for the operational efficiencies it brings.
Yep.
But, you've got DTCC and the Chicago Mercantile Exchange and JP Morgan all coming up with their own distributed ledger settlement systems. And I haven't read the speech yet, but I heard Larry Fink gave a speech at Davos in which he was talking about that he would like to see the entire financial services industry on one ledger. Blockchain technology, that's the evolution of where we're going. So, this tokenization of treasuries, that we're taking U.S. treasuries and turning them into tokens. I mean, that's gone from 200 million just a year ago to over $9 billion worth of tokenized treasuries as we sit here today.
Wow.
I mean, this market is just exploding because the system realizes that for operational efficiencies, getting interest paid, moving treasuries from one account to the other, moving collateral in and out of firms, doing it on a distributed ledger, the blockchain, is the way to do it.
Yeah.
So we are just seeing huge growth in this industry. If anybody owns Ethereum stock, you're probably happy, because Larry in that same speech was saying that Ethereum is the model to be doing this under. He was a real proponent of not just distributed ledger, but Ethereum in particular, which most of them are using anyway.
Right. And that, it's interesting you say that, because this is where I've been telling my students, like, look, the whole system, in my opinion, without question, will be on digital rails within the next decade. All of it, everything we do. Right. The question is which one. Now, JP Morgan is using Avalanche and Ethereum. They've built their own kind of proprietary blockchain called Onyx, but it's EVM compatible, which means it does plug into Ethereum. The question is, if Larry Fink of BlackRock is so adamant that Ethereum is the one, then it would be, in my mind, kind of a no-brainer to hold some Ethereum. Now, I don't know if Ethereum will be the kingpin down the road, but it's certainly starting to feel that way, because Coinbase is building on top of Ethereum. They got their layer 2. Robinhood and many other companies are building on top of it. And I make the analogy of the internet, which is the internet functions because everybody is using the same protocol. If we had 50 different protocols, we wouldn't be able to communicate like we do today. And Larry's right. If we can get it down to one standardized blockchain system, then we're going to see an incredibly efficient market network. So we'll see something that's totally transparent that benefits everybody. And if you're holding that blockchain, you're probably going to do rather well.
Yep. Yeah, and apparently, and you're much more proficient on this than I am, but the smart contracting capabilities of Ethereum is what makes it the real standard to use.
Yeah, the smart contracts can be built on any of the blockchains. So it's Solana, Avalanche, Cardano, all of them. They can build on all of them, but it's the network effect that Ethereum has, and the changes they're making to their system to adapt to scaling. And that's the interesting part right now. Let's go back to bonds. And Steve had a question. He says, how does this bond situation affect equity? So your hypothesis is a steepening of the yield curve. Short end of the yield curve dropping, which it probably should do, and the long end of that yield curve starting to steepen. I'll bring up the yield curve for everybody here right now. So there you have the current yield curve. And what Bill's saying is that this short end will probably start to decline, not just because of the Fed, but also because of just the transactions and consumption of short-term treasuries, and then the long end starting to steepen. So what does that do for, let's say, the equity markets?
Well, the first, from a sector point of view, economics 101, when you have a steepening yield curve, the sector that's going to benefit the most from that is the banking sector. And specifically not the money center banks, but the more traditional banks. Because if you still look, the traditional banking model is to borrow short and lend long.
Right.
So, in an inverted yield curve, the banks were, we were losing banks, right? Signature and others. When the short rates started going up, we were losing banks, and that created the inverted yield curve. It's hard to make money as a bank in an inverted yield curve. Now that we're normal and going steeper, the banking industry is going to love that. But again, I don't want to make it all banks, because your money center banks are much more driven by investment banking revenue and trading revenue. But when you can find a traditional bank with lending activity, they're going to love a steeper yield curve. So that's the first benefit. The other is that the other benefit is that the financial sector actually does better in an inverted yield curve for the same reasons as well. So finance paper in general is going to do better with a steeper yield curve, but with a particular focus on the banking side. And then the other question, though, is going to be, okay, what is Fed policy? Are they dropping rates because we've got a problem with the economy? Are they dropping rates because of political payback?
Right.
I don't mean to sound like Jay Powell, but we got to be data determinant as to why this is happening. As you said, is it going to be short rates coming down, or is it going to be long rates going up, or a mixture of both? Inflation, as a rule, hurts the economy, though. Let's be honest. If inflation does start rearing its ugly head, the corporate earnings aren't going to like seeing that. But we'll have to wait. That's a ways down the road. But inflation within a manageable term, which our Fed says is 2 to 3%, if we believe them, is okay. But anything more than that is going to hurt corporate profitability, and we run the risk of the Fed turning around and starting to raise again.
That's where I was going to go with my next question. Is you mentioned that the banking sector will probably do well if we get a steepening of the yield curve, but from an economics perspective, when companies go to borrow, that raises their borrowing costs, and therefore expansion, maybe R&D, these areas might get hit, and we could see corporate profits decline because of that. I mean, there's going to be a sweet spot. Obviously, at a certain point. Right. The long end of the yield curve is fine, but if it continues to rise, and I don't know what that number is, there will be, declining cost to benefit, and they'll actually start to lose money the more if they're borrowing at higher costs, and that causes economic contraction.
Absolutely. The only but to that I would add is we had one heck of a year last year in terms of new issuance corporates. The size of the corporate bond marketplace grew by over $2 trillion last year, more than we've seen in the last 20 years. And a lot of corporations, we've had this discussion, came to market last year with bonds to finance their AI and R&D and CapEx expenditures. Mm-hmm. So corporate America really leveraged up their portfolio last year. So that might help if rates continue to go higher. In other words, they borrowed a lot more than they needed, quite frankly.
Yeah. Well, unfortunately, that will happen. But it also begs the question: if they issued that much from a bond perspective, to me, these corporations are very astute. They know what's going on from a timing perspective. They know what's going on, with regards to their business and how things are performing. I can't help but to think that a lot of them are going, okay, yields are going to get much, much higher in the future. Now's the time. Let's issue a whole bunch, especially since you saw, you mentioned a couple $1 trillion worth of new corporate bonds. Does that play into this?
Yeah. Yes. No. And the other thing that really incentivized them to do it was the credit spreads were also historically low last year. So corporations didn't have to pay up much over the treasury rates to begin with. So you had low sovereign rates, narrow credit spreads. Corporate America was like, well, we've told them we're going to spend, Oracle said what, 19 billion dollars. So literally the next day after their earnings report, they announced a $19 billion bond offering. Meta did exactly the same thing with a $30 billion number. So they put their foot in their mouth. They made these commitments, and they decided the bond market was going to be their cheapest way of funding it last year.
Yeah, well,
And it was.
time will tell. I mean, I'm with you.
Yeah.
I do see the longer term rising. I don't think it's going to be that steep, but I do think that over time you'll see it slowly trickle up. And where's
Yeah.
that point of diminishing returns from a corporate investment perspective? Time will tell.
Yep.
Marcia says, "Who's the biggest buyer of corporate bonds?"
The asset management industry, and not just hedge funds on the high yield side. High yield paper is predominantly driven by the hedge fund community still. And traditional asset managers, insurance companies, and pension funds are your big corporate buyers by far.
When you mention money center banks, what are you referencing there?
Well, the names we tend to talk about, the Citibanks, the Goldmans, the Bank Americas, they're banks, but they're really financial supermarkets.
Yeah.
A firm like Citibank has not only traditional banking activity, it's got investment banking activity, it's got trading activity. Whereas you look at the old Bailey Savings and Loan, it was just loans and mortgages, right?
Mm-hmm.
So when you have the money center banks, they are engaged in multiple sources of revenue, and they're not really traditional banks in the truest sense of the word. They're supermarkets.
Supermarkets with the buffet of products and services to make them money.
Exactly.
All right, let me shift focus here. I know you're a bond guy, but everybody has to step back and think about where things may be headed this year. Obviously,
Okay.
what's going on lately? Who the heck knows where this year is going to go? I mean, I thought last year we had some political uncertainties facing us, and now it seems like even more for 2026. Any thoughts as to where you think that the S&P is going to go this year? As you know, I do a forecasting thing, and for the viewers, if you are new, you can send in your price quote for what you think the S&P 500 will be at the end of 2026. Long ways away, that's for sure, but there's the goalpost. What do you think? We're going to have a good year? We're going to have a bad year?
Here's my bias, and you know my bias. I'm not an equity guy, and I rarely look over that fence, but I don't understand why the equity market, S&P, hit 65 record highs last year. I just feel that the equity market is so overvalued, but I've been saying that for a year. So
You'll be
who
right some
knows?
point.
Well, that's it. Even a broken clock is right twice a day.
Yep.
I'm actually going to go with a 10% drop to the S&P.
10%.
Put it at 63. Put it at 6,300.
All right. Yes. I think
Me
it's
and Ray
actually,
Dalio are going to have drinks together and celebrate.
it's actually 6150 is 10%.
Okay, thank you. I was rounding at 7,000.
Yeah, I
Okay.
got a percentage calculator here. All right, so Bill thinks we got a 10% drop. You're right with Indigo Clover, very close to his guess on our show as well. How about Bitcoin? I know you're. I feel like you're starting to lose your optimism on Bitcoin and more like.
I am.
Yeah, that's okay.
I am. I'm going to put it right where it is now. Sub 100,000. What are we about? 88,000.
We're 89,200.
Let's put it at 88,000.
80?
Just down a little bit.
That would. Yeah, that would. Let's see. So let me.
And I hope I'm wrong there. I really do hope I'm wrong.
I know. I hope you're right, so I can send you some shot glasses. So you said
I thought we were
89,000.
gonna be betting on who's the next FOMC chairman.
Okay, there you go. That's a fun
Go
one.
ahead. No, finish her.
No,
Finish.
no.
Go ahead. I'm sorry.
I'm curious. Let's go and discuss that for a second. I didn't want to keep you here too long, but who's your take that you think will be the FOMC chairman? And I'll tell you what I'm going to do here. There are. Well, go ahead. Just tell me who you think is going to be the chairman. I'll explain my thoughts.
We got five leading contenders, and the one who is by the odds makers apparently coming up strong is Rick Reeder from BlackRock. The problem with Rick is that the president's liking him is simply based on his interest rate policies, not his politics, because it just came out today who Rick has been giving political contributions to, and it's not going to make the president happy. So I don't know if Rick's going to stay on. Scott Bessent, I know, has been offered the job, but he doesn't want it, or people say he's been offered the job. The Treasury Secretary, he doesn't want to leave Treasury. I'm going to go with Kevin Hassett.
Kevin Hassett. Okay, so
Yeah.
here's the Kalshi app. I don't know if you played with Kalshi app. It's predictive markets.
Yeah, I know I'm familiar with it, but I haven't played with it.
So right now, the number one, 35% chance of being the chair will be Rick Reeder.
Yeah.
29% for Kevin Warsh.
Yeah.
You got
He
Christopher.
has a former governor.
Yeah, you got Christopher Waller is 16%, and
Right.
then both Besant and Hassett are at 7% there.
Okay.
There you go.
Yeah, Walsh was a former Fed governor from 2006 to 2011. He's from the Hoover Institute, real conservative. He would play right up President Trump's political spectrum. I'd like to see Bessent do it, but I don't think he's going to leave Treasury.
All right, so how about this? Just because this is the Bill Addiss trade for the day, I'm gonna put $50 on Kevin Warsh. There we go. So I go put $50 on
Okay.
Kevin Warsh. That wins us 164, which will pay some of your beer debt.
Okay.
And let's
You and I have
put
known each other for a couple of years.
we've known each other for a couple. And you know what? I'll put $10 on who did you say? Besant.
Rick Reeder.
No, you said Besant.
Oh,
So I'll
Besant,
put
yeah.
$10 on Besant. That should yield us about the same, $134. So there you go. All right, I got
Okay.
2 bets on. These are the Bill Addiss trades right here.
But honestly, on a personal note, I'd love to see Rick get it.
Yeah.
I mean, I know Rick. I like Rick. I think well of him. I don't think he wants the job particularly, but I think he'd be good at it.
Lisa, as Steve says, what's the percentage for Lisa Cook? Let me go and tell you right now.
Oh, got to be single. It's below single. It's got to be below 7%.
Way down there. She's not even on the list. Stephen Moran's
Yeah.
at 1%. Yeah, she's not even on the list. Cook's not on the list at all. No one's even betting.
Yeah.
Ron Paul's on the list though.
Is he really?
Yeah, I love that someone has Jerome Powell. There's a 1% that Jerome Powell will get it. Pretty sure that's not gonna. Bill Pulte could be. I could see that, but that's
Oh, yeah.
There's a lot of 1%ers on here. A lot of 1%ers
Yeah.
on here. Anyway.
No.
All right.
We will know in 2 months.
Absolutely, we will. 2 months. Another two FOMC meetings, right? I think we
Yes,
get
right. Two more FOMC meetings. That's the way to look at it.
2 more, and then he's done. You think he's going to stick around?
I do. I really do. I think he just wants to be a fly in the ointment.
All right.
Yep. I think this has gotten personal. I think when he went to this Supreme Court, he was flagging something. Yeah, I think he's going to stay, and he can stay another 2 years. He
Yeah.
can stay through President Trump's tenure.
There you go. Well, I'd like to see him stay. I actually really do. I love when he posted that video in retaliation to the lawsuits against him. I was like, I thought that was pretty. That was good.
Do you and your audience know his background?
I do not.
Would you know how President Trump loves to rail on George Soros?
Yeah.
Did you know Scott Bessent was a founder and partner of Soros's hedge fund?
I did know that. Yes.
Yeah. He comes from Soros's world before he went off and founded his own hedge fund.
Yeah, that's Besant though. That's Besant. Yeah. I thought we were
that's
talking
what
about.
I'm
I thought we were talking about Powell. I was like, oh, Powell.
Oh, no. Scott. No,
Yeah.
no. Bessent over at Treasury.
Oh, yeah.
He's doing such a great job at Treasury, but he's a Soros guy.
You know, it with President Trump, it doesn't really matter as long as you speak what he wants spoken. He'll whatever you did, it doesn't matter.
Yeah. Yep. Yeah. I just thought it was an interesting
Yeah,
footnote
I
on
read
the
that when he
president.
first took office. I was like, "Huh, that's
Yeah.
real interesting." All right, Bill. Let me talk to me about your schedule. I think I can bring it up here, but you are teaching a focus course, Canary in the Coal Mine, where you talk about.
Right.
Well, give us a little rundown of what you talk about, and I'll share the calendar with everybody.
Thank you. We do a 1 day concentrated on the bond market, and it's originally I designed it for those people who are interested in bonds, but the reality is, as the name indicates, the bond market really is a leading indicator to so many other asset categories, whether it's equities, currency, as we were talking about in this program today. Equities, currency, even commodity prices. So, to talk about interest rates really helps people when they're trading a variety of different asset categories. So we try and make it a bit multi-product, but there's 2 constituents that I really try and address this class to. One is for people who are using bonds for trading purposes, and we saw the volatility and liquidity really made bonds a real trading asset during the pandemic, as it was up until this year. So far this year, we're pretty boring,
Yeah.
but in terms of interest rate changes, but there's trading opportunities here. And, I keep talking about that steepening trade and so on. So we're appealing to the trading audience, but there's also the traditional bond buyer, which we call the coupon clippers.
Yeah.
The people who buy bonds for income and safety, and it's kind of the passive part of their portfolio. And I'm a real advocate that people could and should be doing that themselves. In other words, you don't have to pay a money manager to put together a bond portfolio for you. You can do it yourself with a little bit of homework.
Sure.
So I am an advocate of individuals buying individual bonds for income purposes, and we show you how to do that as well.
Nice. Well, here's the calendar for it. The full focus class. So basically, there's 4 application sessions. Those are weekly. You can see here February 11th, he has the full class starting all over again. So if you guys want to jump in that one, you get the starts here on February 11th. He also does the XLT general session on the 25th of February. So check that one out at 10:30 a.m. Pacific time.
Man.
He did one today as
Thank
well.
You are the man. Thank you.
I'm trying. Bill, thank you so much. I always appreciate you coming out. Are you coming out to California anytime soon? I ask you every time you're on the program. I know you said you were coming maybe to
I wish
LA.
I could say there was something on the near calendar, but there honestly isn't.
Where are you based out of?
I'm out of Washington, D.C.
Oh, yeah. I can't go that far. You know, I figured someone told me, how do you get to Washington, D.C.? You go east till you smell it and north till you step in it.
There you go.
Oh,
and that is
sorry.
a good way. I'm going to steal that. That is true.
Terrible. I used to use that one for Texas, but now I got to use it for D.C. given what's going on.
No, I even have family out by you. I have no excuse. I got to get out there.
Well, come on out. The weather is definitely more appealing than what you guys are going through right now, and it's cold and ice.
That's for sure.
I mean, I'm over here shivering because it was 63 degrees. I was like, oh, this is terrible.
Hey, if this weren't taped, I'd say something to you. I'm looking at 11 degrees. 11 degrees here.
We'll censor the show. All right, Bill. Well, hey, thank you very much. I appreciate it. Have a great time in your focus class, and we'll talk to you again soon.
Always a pleasure. Best to everybody. Be safe.
Guys, that was Bill Addiss. If you want to find out more information, you can go to tradingacademy.com, find out more information about his focus class. He also has amhersttraining.co. So if you go here, aftraining.co, he has some books that he's written as well. And you can go over to shop. And I think he's got a set of all 3 of the books. So if you're going to buy one, they're $15 or 3 for $25. So much better deal if you buy all 3. There you go. All right, that's going to wrap up that portion of it. Let's real quickly go into some of the companies reporting earnings today because I know you guys are real interested in that one. I will switch this over to a 5-minute time frame. There are a couple of important ones. Tesla, obviously, in my portfolio, pretty happy with this one so far. You can see right now it's screaming back down in the after-hour session. So we will see if by Friday it closes above that 432.50 mark. That's where I'm at. You had Microsoft as well. They got crushed pretty bad. They were at $480 plus before the market closed. Now you're down at $458, down almost 5%, but that's certainly well off its lows. In the after-hour session, it was all the way down to $442. And then you had Meta, the shining star today, up 8.5% in the after-hour session, 725. Big rip to the upside. It actually started off with a pretty big down move and then screamed to the upside there. Those are your major companies that reported earnings today. You had several others in the tech space, including IBM. But tomorrow, I'm going to bring this bad boy up. There was a shift. So it was supposed to be Apple and Amazon. Amazon got moved to next week, but you have Apple, Visa, MasterCard, Caterpillar, SAP, Thermo Fisher, KLA-Tencor, Honeywell, Lockheed Martin. A lot of big names reporting earnings tomorrow. So keep your eye on that one. Interesting, you saw Amazon move their earnings announcement. I don't know why that was, but there was a surprise today surprise announcement of 16,000 jobs being cut over at Amazon from a corporate level. So that'll be an interesting thing to see how it impacts their stock over the next couple days. On the economic front, we go and see what the economic calendar is holding for us. This is not the day today. Let's go for tomorrow, the 29th of January. We have unemployment claims coming out 1 hour before the equity markets open, and a lot of smaller data. You can see you've got non-farm productivity, labor costs, trade balance, factory orders, and wholesale inventories, including natural gas storage. The natural gas has just been absolutely insane. We can bring up UNG here. Let's bring up the daily time frame here. Bam, there's your daily. Huge moves going on in natural gas. And when you look at the natural gas futures, these are wild as well. Let me clean up some of the screen here, and I'll show you the natural gas futures, which are all over the place today. I don't know what to make of this, but I think that I've got to look in and see if this is contract rollover or what with the natural gas. But most likely it was contract rollover because it says down 46%. Yeah, no, didn't drop that far for that one. Other ones, since we're on that list here of our top markets, surprised to see some of the indexes down today. You have the Russell. I still am short S&P, so that's not doing that well. You guys know I bought directionally puts on the S&P. I bought directional puts on silver. Both of those are underwater right now. Oh, silver. This thing just will not die. I saw a comment from Big Eb earlier saying, that he sold some of his gold and bought some puts on silver. Yeah, it's a question of when. This is no longer a question of if. It is a question of when this thing's going to start to roll over. It will have a day, but the tough part is trying to pick that top, And I got burned once. It looks like I may get burned on this one as well. Fortunately, it's like I say, it's not a big position, just a couple $1,000s worth on this one. So I'm not too concerned about it. But yes, Steve says Russell looking worse than the S&P. Yeah, from a technical perspective, what's happening is the Russell made that nice peak a couple days ago, going back to Thursday of last week, and now just kind of basing and not doing much. If you couple that with the S&P is back to all-time high. So that is great. You had your NASDAQ looking pretty good. And, this will be interesting to see what happens tomorrow because you've got Microsoft, which is the second major component in the NASDAQ, really pulling it. It'll pull it down tomorrow, but then you have Meta, which isn't as powerful, will be pulling it up, and Tesla as well. So it'll be a dogfight tomorrow to see where the Nasdaq goes based off those three earnings, and then you have Apple reporting aftermarket hours tomorrow. So Nasdaq all in all looking pretty good today. Not quite a shooting star formation here. Bitcoin, nothing really exciting here. At least it was a positive day, right? I mean, at least it was positive. And then there's gold. The gold futures just gold on an absolute monster run here. I just shake my head in absolute disbelief. I'm hearing more and more about central banks accumulating gold, and I think that does echo some sentiment that you hear from others, not just myself, that there is global issues abroad and tensions starting to flare, and financial insecurities with regards to Japan, with regards to the United States, and just maybe that's preparation for it. But gold absolutely going nuts. I did not sell my coins. Big Ev said he sold his gold coins. I'm keeping mine. I'll keep mine probably until they get inherited by somebody. So not selling for me. Anyway, that is your economic calendar for tomorrow, your analysis for markets for today, and of course I'm over time again. I really wanted to make this a less than 1 hour show, but here we are at 1 hour and 2 minutes. So no guest tomorrow yet. I may have a guest next week. I do have John Rowland will be on Tuesday. I'm still trying to get Larry on the program because Larry, I want him to come up with his forecast for where the market's going to go. For those of you who are new, actually everybody here is pretty much regulars, but if you are just sitting in the shadows and you are new, type in the chat what you think the SPX will be at the end of the year and what Bitcoin will be at the end of the year, and I will add you to this list. If you already did it, don't do it because I'm just going to take your first number that you gave me. So that will do it for today's show, everybody. If you have things you want me to discuss on tomorrow's show, say, Jeff, you're not new, buddy. You're old. He's old. If you have something you want me to discuss on tomorrow's show, email me at tradermerlin@gmail.com or put a comment down below any of the YouTube videos, and I will get to those on tomorrow's show. So take care, everybody. Have a fantastic remainder of your day, and I'll see you on Thursday.